Hello, my name is Richard. Welcome to the Richard on Economics podcast. It's available on Spotify, Apple Podcast, Google Podcast, YouTube, and Qingting FM. Today is April 10th, 2022, a week before the tax due date of April 18th. Today, I want to let you on a little Wall Street secret that may give you a slight advantage. Next week is the tax filing week for American taxpayers, which is going to have a negative impact on the stock market. I predict the stock market will be lower due to the tax filing. The simple reason is that people have to sell their stock to pay for their tax before April 18th. Some of you may ask, Richard, don't we have the same thing every single year? Why is this year different? Yes, you are correct. We do have the same tax filing week every single year. But this year, referring to 2021, is particularly different for the following three reasons. First of all, unlike other years before, the stock market ended the year of 2021 with an all-time high at the end of December due to the Santa Claus rally. This is the all-time high in the history of the stock market. Even though the stock market has dropped since the new year in 2022, it doesn't matter because the tax year 2021 ended in December. So in 2021, the S&P 500 returned a stunning 29%. It's not the highest return in terms of percentage, but it's the highest in terms of dollar amount. So people had a lot more profit than a typical year. For example, compare with 2020, where the stock dipped in the beginning due to COVID, but it snapped back later in the year. S&P 500 ended in 2020 with only 18% increase. So people in 2021 had a lot more realized gain to be taxed by the IRS than other years. The second reason is a lot of new retail amateur investors enter into the market in 2020 and 2021. Unlike professional investors, retail investors tend to do a lot more tradings, going in and out of their positions. They are probably less aware of the tax consequences of their trading. Many call themselves hodlers, which is short for hold on for dear life. They are more likely to hold on to losing positions. For example, let's say someone did 300 trades over 2021 and made 150K on some trades and lost 120K maybe on paper. If he doesn't sell his losing positions, he may have to pay tax on the 150K profit, where he is unable to deduct any loss until later years. A sophisticated traders will want to offset their gain with loss. So in the end, their taxable gain is only 300K. Even better, a sophisticated traders would minimize their realized gain to about the same as the realized loss, so that they would have no taxable income. Retail investors are less likely to implement this strategy, so it's likely that they will have a 150K realized gain and 120K unrealized loss. So they have to pay tax on the 150K realized gain. The third and final reason is that 2021 is the year to be remembered in the stock market history. Not only is it at the top of the epic second dot-com bubble, 2021 is the year of the Wall Street bets and meme stocks. Investors flock into the meme stocks like GameStop, AMC, SPACs, and others. They use extreme strategies like call options, short squeezing, hodlers hold on for their life, and YOLOing all their life savings. For those who don't know, YOLO is short for a quote-unquote sophisticated trading strategy called You Only Live Once, which is a topic for another podcast. In the world of hodling and YOLOing, some people will make a lot of money, whereas many others will have a huge loss. For example, one person may have a realized gain of $500,000, whereas another person may have a realized loss of $500,000. People may think that the IRS will break even in terms of tax collections. No, this is a great news for IRS. In the eyes of IRS, they will collect the full tax on the $500,000 gains, where only allowing the deduction of $3,000 on the $500,000 loss on other person. So as a general rule, the more people day trade, the greater the windfall for the IRS, even in a zero-sum game. So no surprise here, retail traders always get the short end of the stick. When will the selling happen next week, and how do we take advantage of this? I predict some of this selling will happen on Monday and Tuesday of next week. Most people are finalizing their taxes this weekend as I speak. They will have a rude awakening and will be shocked by their tax bill. On Monday and Tuesday, they will have to bite the bullet and start liquidating some of their stock positions to pay for the tax. The reason it's Monday and Tuesday, but not on the tax day of 18th, is because it will take some time for the stocks to settle and money to be transferred to their bank account. I predict the stock market will drop 2 to 3% by the end of next week due to this effect. It's not a huge move, but it will give my audience a slight advantage. To take advantage of this phenomenon, I would recommend investors to short Nasdaq future on Sunday night. The idea is to front run their trades the night before the retailers do. Most retail investors do not have the privilege to trade futures on Sunday night. The best they can do is to trade pre-market on Monday. If you don't have access to a future account, I would recommend you to short QQQ or long SQQQ before the market opens next week. Just a note here, leverage ETFs like TQQQ and SQQQ are meant to be very short-term trading. You will lose a lot of money if you hold it for a long term. Alright, hope this helped. Happy trading. Disclaimer, the information contained in this podcast is for educational and informational purposes only. I'm not your financial advisor. Investing is very risky. Please do your own research. Please consult with your personal financial advisor and tax advisor before acting on the advice contained in this podcast. See you next time.